Good evening, traders. Today's Saturday, January 14th, and I've got a loaded and packed session for you today. We're going to go through just a couple scenarios for next week that you have on your screen already. Then I'm going to show you a short video of actually my work that I do at work and translate that to how I see the markets and how I see the algorithms working. Then I'm going to show you how to pick the tops of rallies. I'm going to go through all of 2022, show you those scenarios. Then I'm also going to show you that a video from David Hunter, longtime money manager, who's been doing this since the 70s, and his viewpoint that the markets have already discounted all of these interest rates and the federal total assets, mortgage-backed securities. You know the $9 trillion that the Fed, or the $5 trillion that the Fed has pumped into the markets ever since 2020. So per David Hunter, he says all of that is already priced in. And then I'm going to show you guys the math that actually proves it, what he's saying conceptually. Then I'm going to show you XLF in 2008 compared to 2022, 2023, and then we're also going to do a quick review of the February 2002 scenario where it looked like it came back up and only to crash down further. Okay, so let's get into the scenarios for next week that I have on the screen right now. Okay, so basically you guys are probably aware we closed at 398.50. Let me zoom on in here. Okay, I mean, these are the various scenarios. I think in any scenario, we are going to push past that weekly EMA 50 right here, 400.40. Remember, the EMA 50 and the SMA 20 gray line, both the weekly, these are both the weekly, and this is the weekly chart you're looking at right now. Both lines have denied the markets in 2022. This is the December. See that? It popped up only to ultimately deny it. But if you look at the pattern, up, down, higher, low, up again. Okay? So, this is what I see happening. I think we're going to push past that line, the 40, the 400.40, the EMA 50. But then the question becomes this that I want you to look out for. I don't know what it's going to do. How does it back test against the EMA 50, 400.40? How does the back test, what is the outcome of the back test? Does it's going to be a yes or no answer. Does it successfully back test it and then keep going up? Or does it fail the back test, consolidate just under it, and then push back up? Or does it fail the back test, consolidate under it, and then fail again? Okay, that's really the scenarios. Okay, and then if it fails again, that now it has a chance to find support on the SMA 20. Kind of chop around here a little bit, potentially try again. Okay, so I don't know what the answer is. We are going to find out. I'm just laying out these scenarios for you to watch for. At any rate, do not go long. Do not go long until you get confirmation during the trading hours of a successful back test against the EMA 50 on the 5-minute chart. Okay? Do not go long until you get successful back test on the 5-minute EMA 50 during the trading hours. I can't be more clear. Okay? So, that's basically all I wanted to say about next week. Okay? So, let's get to that video I was referring to right here. Okay, here is the Cerner logo. This is just an example of a report that I wrote. Here's the program itself on the left-hand side. I want to show you something. Here's the program. Let's run it. Now, just for now, just, nothing spectacular. Look at this SIA IHC immunohistochemical. Okay, just I'm going to keep this up for now. Okay, so you can visualize it. And what if I hold on? I'm going to do something to manipulate you. Just to show you an example of what I mean. Okay, look at the to date. Okay, nothing spectacular right here. SIHC. Okay, click refresh. Let's run it again. Oh, well, what happened here? To date. This is your new trend line. And IHC, this is now a head fake. Here's the point of showing you this. This output that you're looking at on the right-hand side here, that's how I view price action on charts. Prices are outputs that you and I see, and therefore are easily manipulated, as I've just done to the end user right now. I made a few changes, and I can manipulate you. I can change your thinking. I can make you think the way I want you to. That's key. I just showed you what I just did. Okay? Now, but there are some things in this program I cannot change. I am bound by the rules. For example, and I don't intend to change anyone into a programmer, declare my stain equals VC. You have to make a declaration statement and turn it into a variable character. Okay? You just have to. Because the inputs are variable characters. Okay? Now, I want to call your attention to something else. You know those wicks and candle bodies I like to talk about, and how I like to connect wicks and connect the wicks together to draw trend lines from? Well, that's equivalent to, in this report, you notice here, column positioning, row positioning. That's equivalent. All those wicks as part of the algorithm. The program is ultimately setting those wicks in certain, very specific and predetermined positions, as you see me connect wicks over time. See what I mean? It's all the same thing. So that's why I'm not interested in what's going on the right-hand side. I'm interested in what's going on the left-hand side. That's why I don't follow price action. Because as you've just seen, I can manipulate you. And that's exactly what they do every single day. They call them head fakes. They call them pump and dumps. They call them bull traps. They call them bear traps. Okay? That's the point I'm trying to make to you guys. That's why I don't follow trend lines. I don't follow any of that other stuff. I follow things the markets cannot change and they cannot hide. Just like there are certain conventions in this program here you must follow. You cannot hide it. You cannot get around it. You cannot manipulate it. Just such as, these, setting the column and row positions, right? And what I showed you earlier, setting this to variable character. You have to declare it before you can enter that subroutine. So those things that cannot be manipulated are the MACD, the RSI, the EFA, and the SMA. Those things the market makers cannot hide. See what I mean? So MACD assesses momentum, RSI assesses strength. Price might go through the roof, but momentum doesn't follow. So that's what I mean. I, as a market maker, can manipulate price just like I manipulated this just now. But I can't hide the fact that I'm weak just under the surface. Okay? It's the same like it's almost the same analogy of, well, he's got a large a loud bark, but he's got no bite. Okay? Behind the facade, it's actually a totally different story. And that's what I want to see on the left-hand side. I want to understand the algorithm. And since I'm a programmer by trade, it's natural for me to try, since I write programs, therefore try to think like one. Right? That's just the name of the game for me. Uh, as you can see, I can manipulate the output. And in this case, the output is price. Okay, that's all I wanted to show you guys on this one. Okay, so let's get back to the presentation. Okay, this is some good stuff right here. This is all of 2022, by the way. 5-hour chart, because that's the lowest time frame. I can go back to the January date. Okay, it really boils down to this. You guys could have picked the January top because the MACD on the 5-hour time frame showed bearish divergence like days before it was coming. There's the red arrow, there's the divergence, good night. Once again, as it came up here, what's this, February. Look at the divergence, good night. The divergence between this top and this top. See that? This top and that top is the same as divergence between that top and that top. Boom, 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 goodbye. Okay? Now, as you came up to this one, as you came up to this top, you could tell this is going to collapse too, because this one is showing, divergence with this one down here. You just, it's not making a higher high. Okay? Now, let's go to May, April, almost at the bottom. Remember this? Remember this buzz cut, a flat top haircut right here? Look at that. Look at the MACD was showing you. Uh-oh. We're going to go night-night. That'd have been a time to short. Okay? Notice how, here, let's go to this top. August. Yes, how can you forget August? August peak. Divergence. Again. Okay? Let's go to November, December. You can start to see divergences. See that? Okay. On the 5-hour MACD, you notice that the exact low of the MACD is June 16th. That's the low for the markets too. That's interesting. Okay. Just one more final comment on why I don't draw trend lines. Because, as I said in the video a moment ago, the market makers gave you this data point to connect to. And until the market makers gave you that point, you had to wait for it. You had no idea. See what I mean? So if the market makers gave you this data point and they give you that data point, now they want you to just kind of easily connect the points. So now, in my opinion, you're playing right into their hands because you are connecting points that they want you to. That's my point. That's why I never draw trend lines. I will only draw trend lines within a channel that I've identified. But these are regression lines. These are regression or best fit lines. They're not trend lines. Okay? And here, this is a great example that you would have been totally just astounded. Like, oh, see, remember this? August? Remember this peak? That was like September CPI? You'd have been like, oh yeah, here we go. It's over now. you're going down after this, right? They would have had you. You would have thought you had the markets dead of rights. You would have been like, I am shorting this sucker, only to get what? Boom, ripped the other way. Trend line invalidated. And they would have played. They would have had you played right into it because that kissed the trend line. Oh look, it's kind of following along the trend line. Yeah, that's exactly what they wanted you to see. Only to rip it on you, and we haven't been below that since. Okay, that's why I don't draw trend lines, because I don't look at the action out here. I look at the action inside here. All right. Okay. So now let's get into the meat and potatoes. Okay. Got some good comments and questions from my last video, such as, how is the markets going up even when there's still quantitative tightening? Right? That's a very valid question. Okay? And that's why I have this up right now. Okay. Did you know that ever since 2020 right here, $4.1 trillion was already in the markets? Quantitative easing, 4.1 trillion right here, right there. See that? We went up to 9 trillion, basically. So we added another $5 trillion. Did you know there's still about 8.5 trillion in the system? Okay? So they've only gotten rid of about 500 billion. 8.5 trillion is still out of 9 trillion. Still in the system. Okay? So if you're wondering why, how come we haven't gone down further? Why are we still going up? That's the answer to your first question, to that question. There's still a whole boatload of money still in the system. But having said that, so that's just the money in the system. Okay? That's the money in the system. Having said that, I'm going to show you the video of David Hunter momentarily. And he's right, because I'm going to prove it mathematically. The markets have already, you'll hear him use this word, discounted all 5 trillion. The markets have already priced in or discounted all 5 trillion that has been added since 2020. And I'm also going to prove that mathematically. So even though there's still a boatload of trillions in the system, the market has already discounted it as if it's already gone. Does that make sense? Okay, I hope it does. That's what David Hunter means when he says it's already priced in. They've already, like, moved on. And you guys know the federal funds rate is going to be over 5%, whatever. They've already priced that in also. Because if you and I know what the basis point, you know, we all know next month it's probably going to be like a 25 or 50% basis point hike, and then there's going to be a pause. Okay, well, the markets knew that months ago, right? I would even contend they already knew that before the FOMC even made that new rate schedule announcement. They already knew. Markets have priced that in also, meaning they've factored that rate, that 5% rate, already in. Okay? So I hope that answers your question. Like, why is the market still going up? Because they've already priced it in. They've already priced all this stuff in. That's what led to the October 13th, the hive low. They priced it in at that time. Priced it in, priced it in, priced it in, priced it in. And now they're moving on. See what I mean? Okay. So you know, based on the other question that I got from a commenter, subscriber, you know, well, first of all, we're not in a recession yet. Actually, GDP numbers are actually positive. So we we cannot say we're actually in a recession because, first of all, you have to have two negative quarters in a row, and that hasn't happened. And usually they don't determine a recession until maybe up to a year after it's even happened. Okay, and they're even debating right now. You heard Fed Chair Bullard, not chair, but Federal Reserve Bullard say, yeah, well, we actually might have a soft landing after all. See what I mean? May not be a hard landing after all. That's coming from Bullard. Look him up in the news. You'll hear him say it. So, but nonetheless, the markets. This is all over the news. The markets are already pricing in a shallow recession, a mild recession. And speaking of recessions, how do stocks perform during a recession? The answer may surprise you. Did you know stocks usually decline before the recession hits? The average decline for the S&P during the past 10 recessions is only 2.2%. The past 10, 2.2%. The median decline, 4.9. They smacked it dab in the middle. It was 5. Well, just round up to 5. 5%. 5%. Okay, so hope that answers your question. I didn't exactly answer it, but there's still debate whether we're even in one, and the markets are already pricing it in. And the average for the last 10 is just 2.2% decline, guys. Because I'm going to show you in 2019, the average return for 2019 for the S&P was 28%. So I hope that answers your question, like, why isn't the market going down? Okay, let's play David Hunter, shall we?
Understand that. The other thing that I think are oftentimes retail investors and traders don't understand is that there's a discounting nature of markets, so that they're thinking the news today is what drives markets, but markets are often, stock market certainly, it looks 6 months into the future, and you can use, you can draw on many different things to kind of draw conclusions for what's going to happen in many months out. And so the retail investors looking at the news that's announced today on some economic data or what have you, and they think the market's going to go down and it goes the other way, and they don't understand it. And it's because lots of times that was discounted months ago. For example, right now, people are talking, the big narrative on the street is that, earnings estimates for the market are too high, and that we're probably going to see, earnings estimates come down next year dramatically, maybe as much as 20%. And so they're saying there's going to be a time in the next few months when the market's going to have to deal with the fact that earnings estimates are too high, and that they're going to, trade down on the lower earnings estimates. I go, that was discounted months ago. That's why we're where we are. That's why, in October, you had the S&P at 3,500, and you had lots of tech stocks down, well over 50%. It's, the market looks out. It can put together a lot of pieces and know that stuff way ahead of when you think you know it, and or when you're told about it. So I think that, my view is the market did bottom on October 13th, and that we're going to, look past that weak earnings in the first and second quarter. So um, it's I think that's hard for retail people to grasp, is that discounting nature of things.
The discounting nature of things. Look past the weak Q1 and Q2 earnings. Why are they going to do that? Why would they do that? It's because they are forward looking. And now let me show you some math. Okay. Quick, in all of 2019, 28.65% return from January through December. Those are your levels. That's the return in 2019. Okay. Now, If we, okay, and here's where SPY closed on Friday, 398.50. Okay, if we rewind, so 302.63 is the level on September 19th, 2019, right here. I chose this because this is at the top of this channel. Notice I didn't choose this, or I definitely didn't choose any of this mess up here. I just chose this because this is the top of the channel. Okay, 302.16 on September 19th. If we, let's rewind and pretend today's date is September 19th, 2019, and we cut out everything to the right. We don't know what's going to happen tomorrow, September 20th, tomorrow. Okay? Today's date is September 19th. What the markets do is they use the compounding interest calculator. So, in this case, it would have been near 28% return already to project into the future. So if today's level is 302.63, what's going to happen? This is 3.5 years from now. They can calculate the rate of what the level should be in the future based on a 28% return, right? That's just basic compounding interest. You guys know this. 30% of 100 is 30, but then now it's 130 times 30%. That's a bigger number, right? It's compounding on itself, compounding interest. So, now, having said that, let's take September 19th and go backwards to March 5th, 2009. That is the low of the GFC. SPY was 67.1. Okay? 10.5 years later. 10.5 years, the difference between March 09 and September 19, the 19th. Right? It's 302.63 from 67.1 to 302.63. That's an average return of 15.426%. Okay? Now, let's go to some calculations. So, what I just shared with you is this first row. 10.5 years have elapsed. SPY's future price at September 19th is 302.63. You started from 67.1. If remember, we pretended that today's date is September 19th, 2019. If you're going to take the current level, 302.63, and apply the same compounding interest that you've had in the last 10.5 years, which is 15.426, and you apply that over the next 3.3 years, what should SPY's level be? 487.96. Okay? So if today's date is September 19th and today's SPY level is 302.63, and you apply the interest, compounding interest that has been applied the last 10.5 years, and you apply that over the next 3.3 years, 3.33 years, which brings us to today's date, SPY should be 487. Okay? That's assuming no recession. You're just using the existing 15% return. Mind you, that's why I called out, actually 2019 was 28.65% return. 28%. I'm going with a much lower number. I'm halving that. Okay? I'm not going by the bigger number. I'm going by the smaller number. Remember that stat I just showed you? Oh, usually in a recession it's like 2%. So I just took 2%. I just knocked off 2% from 15 and I just called it 13. SPY should be 460. What if it's a moderate recession? Remember that median number you saw, 4.9? I just rounded up to 5. 5%. Instead of 15%, it's 10.426%. SPY should be 420. What if it's a deep recession? I just took 15.426, divided that by 2. Half the returns. SPY should be 387. Okay, we're at 398. So the only lower number out of all these calculations is a deep recession. You follow me now? Notice how, like I said, I chose this data point to calculate future returns, not any of this jazz. That's why I said pretend like this was never there, just gone. So the compounding interest, so to go in the reverse, what David Hunter was saying is, well, the markets have already discounted that. To go in the reverse, what he is saying is, well, if you go from 487.96, if the market discounts it, the price you should be paying for a 15% return, 15.426 return, is SPY 302.63. So that's what David Hunter was talking about when he said SPY already went down to 3,500 in October. Actually, technically 348.11 exactly. So, but round it up, that's fine. 3,500. What David Hunter is saying is they've already discounted all that. And this calculation using September 19th forward proves that. Yeah, they discounted it. That October low has already been discounted because my starting point is September 19th through today using historical compounding interest to calculate what the current levels should be. And what the current level is proves, yeah, they've already discounted all that. And they've already discounted negative earnings because of that. Basically, from top to bottom, has already taken into account the subtraction of 5 trillion. It's already gone off the books. Even though physically the money's still in the system. Physically, the money's still in the system. But accounting wise, they've already taken it off the books. They've already written it off. You follow? Okay. That's why I chose this date before this big upthrust. Okay. So I hope that makes sense. Let me know if it doesn't. Okay. So while we're at it, let me show you XLF. Real quick, 2008 on the MACD XLF. This is the daily chart for 9.5 months out of the year. The MACD was under the zero line. 9.5 months right here. Look at that big old deep. Looks like the bottom of a lake or something. I mean, look at that. 9.5 months. Well, actually, I'm not including this as coming over because I mean, you didn't make a big move. So from here all the way to here, you were underwater. This is 2008. Let's compare that to 2022. Underwater for 2 months. I'm including this, and then a couple weeks right here in December. So, if the financial sector is the lifeblood, the banks, right? You saw the earnings that they released this week. Right? Look at the charts, just down, 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 up, down, up, down, up. Not the same at all, guys. This is the financial markets. Okay, so that's why there's just no comparison. The GFC cannot be compared to 2022, 2023. It just can't. All right, so one final thing I want to show you. I got a question. Oops. Hold on a second. Ooh, 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 ooh. Yeah, here we go. Yeah, this will just be, pretty quick. Okay, so first of all, this is February 2002, 2002, the net crash, the dot-com bubble. So, as you see right here, the MACD showed major, massive bearish divergence here as compared to here. And you guys know my criteria. You can't be failing the back test on that EMA 50, can ya? And you did right there. And on top of the bearish divergence, I would be like, oh no, you're going down. Okay? But as noted a few moments earlier, you guys remember in 2002, there was an 8.5 trillion in the market. Remember QE, the father of QE, Ben Bernanke, started in 2008. So we're still 6 years early, right? In 2008, there wasn't, I mean, we just started. So the first 4 trillion was from 2008 until 2000, what, 2020, we'll just call it 2020, before the pandemic. So for a long time, it was only 1 trillion. Right now, we have 8.5 trillion still in the system, but the markets have already discounted it. They're like, no, no, we're pricing the current market levels as if it's not there anymore. They've already discounted it. That's why the market's not going down. Also, there's too much money still in the system. Okay, so um, as of right now, I'm not seeing a bearish divergence. Okay, so in the 2022, that's basically in relation to what I see here in February. This was December, November, December through February. Massive bearish divergence here. Boom, fall. It's going to fall. So, um, not seeing that yet. Not saying that it won't, but I'm just not seeing it yet. Okay. So, just wanted to let me show that, get that out of the way. Again, had some comments. Oh, you're fighting the Fed. No, we're not fighting the Fed. We're not fighting. At the end of the day, guys, it's straight math. It's just math, and it's algorithms, and it's programs. But at the end of the day, it's math. Nobody's fighting the Fed. The markets have already discounted it all the way down to 3,500, October 13th low, the hive. And I've mathematically just shown you that. I proved it. It's been discounted because I took September 2019 forward and excluded all of that huge run up. And we're still coming, and I'm coming up to similar levels where S&P 500 is already today. The markets have already discounted it. Nobody's fighting the Fed. They've already, in fact, they're not fighting. They've taken into account the 5% already. They've priced it in. It's been discounted in. Okay, so I mean that's just you heard from David Hunter. They're already 6 months out, guys. They're not looking at earnings coming up in a couple weeks. They're like, yeah, we already know about that. We already priced that in too. It was priced into October because they knew they're like, oh man. Okay, so if you eliminate 5 trillion, what's that mean? What's that? How does that translate to the present value of the future returns when you subtract 5 trillion over the next 10 years? See what I mean? That's what I'm talking about. Okay? Nobody's fighting the Fed. So, in case you're wondering, how do I know about all this stuff? I have my master's in business administration. I took a lot of finance courses, including courses on stock valuation, calculating present value based on expected future returns. This photo is only photoshopped where my name has been removed. Okay? That's why I just wanted to show you all those calculations today. And feel free to follow me on Twitter where I give real-time tweets during the daytime, during the market intraday activities. Please don't forget to listen to your favorite music while you're trading. It matters. Helps you get into the zone. Right? Help you achieve Zen. Please give this video a like, share, subscribe, or click to be notified. And with that, I'm Agent 000 signing off.